Stock markets rolling over for the second day in a row. Is this bull rally losing steam? Well, on the short term, it does seem to be that way, but what's going to happen over the medium to long term? Chris Vermeulen is here to break down market action with us. He is a chief market strategist at thetechnicaltraders.com. Welcome back to the show, Chris.
Hey, thanks for having me, David. Always a pleasure.
Always a pleasure to see you, and congratulations on your book launch. We'll talk about that towards the end, but let's talk about this market action. So last week, very bullish for both the stock markets and cryptocurrencies, as we saw the Federal Reserve pause rate hikes. They've indicated that they may hike another time, and certainly the futures markets reflects that. But anyway, last week, both the NASDAQ and the S&P were up. Today, the NASDAQ is down 1%. Is this just a correction on the downside because of how things went last week, or are we seeing bigger signs of a larger market correction to come?
Yeah, so when we take a look at it from the short-term basis and we look at the charts, so if we take a look at the SP 500 daily chart here, I mean, the market is still on a tear to the upside. It has pulled back the last 2-3 days here, and it's still in more or less a high momentum move. I have this little blue line here. It's a 5-day moving average. Typically, if you're in a very strong momentum move, the market will pull back, tag the 5-day, and keep riding up. So we're right at this threshold where is this high momentum move in the stock market going to continue? And it can flirt with it for a day or two. The NASDAQ gives you a really good view of kind of how it has done in terms of running up this blue line, pausing for a couple of days, and constantly just finding support and moving up. So today is a day where we're seeing some panic selling in the stock market. We're seeing the market leaders moving down the most. So the NASDAQ, growth stocks, AI, things like that are pulling back. But we're still in a very bullish pattern at this point, and the trend is still up. But today's a little bit of fear creeping in, and people, short-term traders are taking profits because we're breaking some short-term lows from previous sessions. And that's where short-term aggressive traders are going to want to get out, lock in their profits before they give back too much. So this market is still very, very strong. I mean, when we look at the NASDAQ here, in terms of the trend analysis, it has been ripping higher, hitting our targets. And, we've been catching this move in the NASDAQ, which is amazing. It's been one of the strongest moves. And the key is to be able to identify these and peel money off. We actually got out of the NASDAQ right up here at a 15% gain on this most recent trend, because the technicals have reached a level where typically we see volatility step in the market. We typically see a type of correction. So we're expecting a little bit deeper of a pullback and a consolidation. Maybe the market is going to consolidate a bit and give us a new buy signal for the next leg up, or maybe it's going to actually top out. So we just have to see what it's going to do. But the key is to make sure you don't miss out on these moves by following the trends and taking advantage of these really strong sectors and moves in the market.
So can we just take a look at the chart one more time? Are you seeing any signs of the market being overbought last week?
It was a little overbought. I mean, our short-term indicators were telling us we started to see a bit of FOMO, meaning you look at the volume flow in the New York Stock Exchange, people were piling in, kind of hand over fist, just buying stocks, feeling like they missed out. And that happened really right at the last two green bars on the NASDAQ, the SP 500. I think we're seeing some short covering. I think we're seeing people pile in, feeling like they're missing out. And when we see everyone typically buying New York Stock Exchange equities, those are kind of just the masses, the emotional people chasing brand names. They're the only ones they really know off the top of their head. And so that's always a short-term sign that, hey, we're probably going to see some selling for a few days. The question is it a pause, or is it the start of a deeper pullback? So that is what we've seen. And on a different angle, I also look at the put-call ratio, and the put-call ratio is down at a level where we typically see a 5 to 7 or 8% correction in the markets. So we're definitely flirting with an overbought territory when it comes to sentiment. People chasing prices now, and everybody is buying leverage to the upside at a level that is telling us that, okay, there's going to be some pain inflicted here, that everybody who's been chasing, thinking the markets are just going higher, they're all about to get burned probably with some type of pullback until it shakes them out and gives them a loss. And then maybe we'll see the market pick back up and rally even further.
Have you noticed any changes in overall volume? Has trading volume declined or increased? Certainly it feels like sentiment is kind of slower right now. People are there's not a lot of news happening in the finance markets as much as maybe 3 months ago when the banks were collapsing, and things are starting to feel a little bit quieter. I don't know if you're feeling that on your side as well.
The volume actually, believe it or not, in the past week or so has actually picked up. It's been pretty heavy. And I think that comes into, I think we're seeing people finally give in saying, I can't believe this market keeps going up. I'm missing out. I'm missing out. And I think we've seen a lot of people piling in, kind of chasing prices, which we've seen an elevation in stocks. And I think we are seeing people who can't take the pain of being short. And, the market has broken some critical levels. When we look at this previous high that we saw back over here, once we broke here, that's where the volume down at the bottom of the chart started to ramp up. So that is where people are now saying, okay, the market is now making a major higher high. If I'm short, I don't want to be short anymore because it could scream to the upside. So we are seeing definitely people buying back shares, and that is probably the shorts covering, and the shorts could also be buying long, saying, "Hey, we're in a pretty major uptrend. I want to get in." So I haven't noticed it getting quiet. What I notice is there's emotions are flying high right now. Elevated volume means increased emotions. So people are either taking a loss with their shorts or they're jumping in because they feel like they're missing out. So it is an emotional state right now, and all of my indicators, including the volume, are telling us that. But it feels kind of like we're in the, somewhat in the summer doldrums. I don't know. It's maybe just because I understand the markets. Big volatility doesn't really get my blood flowing. It's just typical price action. So I'm pretty calm and cool when even there's big chaos in the equities market. But everything seems to be running as it used to pre-COVID. I actually posted an article on this last week showing how trading was before COVID, how it was during COVID and after COVID. And there was a huge difference between those. And really right at the beginning of 2022, the markets actually kicked right back into normal trading conditions. All the short-term traders who were novice and kind of trying to moving into the markets with lots of options, they really skewed a lot of data. But 2022, we got right back into typical price range, and everything we've been seeing since then is just normal cyclical action. And the market doing what it does best is, shaking things up and trying to keep people out of the markets or out of big trends.
Just as you're talking about FOMO, I looked up this article. It came out yesterday from Bloomberg. I'll read you the headline. Bull market FOMO finally sends stock ETF haul past bond funds. So after a tepid start to 2023, nearly $102 billion has flowed into equity exchange-traded funds so far this year, according to data compiled by Bloomberg. That compares to $93 billion for fixed income ETFs, which had been sitting on a bigger year-to-date haul than stock funds up until this month. So, yeah, even the headline of this Bloomberg article, FOMO buying is finally kicking in.
Yeah, and there was, sorry about that. There was another article I read this morning. Somebody came out full of great charts. It was all about real estate, and the headline was something like that: the new bull market in real estate is happening. Record amounts of new home building permits for multifamily dwellings, and also, I mean, the way they make it looks like it's, the market is on a tear. But the reality is, when you look at the charts of single family dwellings and the multifamily, the info that they pack out, single family dwellings are right at a peak. They've rallied up. This is a very cyclical type of move that happens every year for real estate, but it's actually making lower highs and lower lows, the real estate market. And then multifamily is like, it's the more affordable way to build homes. It's the only way you can squeeze. Like, I'm looking at real estate, I'm looking at multifamily. I'm not looking to buy, but I'm trying to get a gauge of things because I do think it's going to go down for a few years. It's going to be an opportunity. So I'm deep into researching multifamily homes in my area. And, the fact that they're saying, oh, there's a new bull market in real estate, record sales in multifamily. The only reason there's multi-sales in it, huge amounts of people getting into it, is because they're more affordable to build. It's more of a passive income strategy. And there is no money really left in the retail, in kind of the regular single family dwellings, because we're in a bubble phase. Real interest rates are going up. I mean, I think the real estate bubble is over. And the only way you can squeeze a little more juice out of this market is to do multifamily. So they're saying it's a bullish thing. I'm saying that is the last straw before the market collapses. It's everybody's got their own perspective, but man, they can sugarcoat something that is like gets you on the wrong side of on the wrong asset, like just the worst possible time.
Okay, so let's role play this. So I'm somebody who's showing you a very bullish chart, and there's a bunch of headlines from all over the news. By the way, people are pulling this up on Twitter. Like all these bullish headlines are all of a sudden appearing all over the news. Sentiment was despondent a few months ago. Now it's obviously people are FOMOing back in. If someone were to say to you, just take a look at that chart you just pulled up, Chris, and that market's gone up in a straight line. It doesn't look like momentum is about to stop anytime soon. Convince me that I'm wrong. Convince me that this bull market is eventually going to phase out because I'm not seeing it in the charts.
Are you talking equities markets?
Yeah, S&P 500 in particular.
Sure. Okay. So the way that I look at it, and you guys, I mean, we've covered this quite often, but when we take a look at it, we're back to the stages. I believe we're in a stage 3 topping phase. If you look at the ARK ETFs, the growth stock curve, this is what happened in 2020. They went up, they cracked, and they've put in a top, and of course they're floundering already. But the rest of the stock market is in this stage 3 topping phase, this rally mode right here. And this is where the emotions come into play. This is where everybody is hung up and trying to figure out where the heck the markets are. And it's that complacency mode. And so people think that 2022 was the bear market. What we need in order to cleanse the market to finish this stage 4, this financial reset, is we need people to think that a new bull market is starting. And that is exactly what we're seeing. We're seeing all the ARK ETFs are on the top of our best now asset list. The tech and growth stocks are all performing very well. We're seeing a big short covering. We're seeing higher highs and higher lows in the charts. But from a long-term technical standpoint, when it comes through the whole cycles of which assets perform best at different times, we're actually in this phase where we need all these people who were bearish before to start covering and buying. And they're all buying like a feeding frenzy right now. The amount of leverage in terms of options, they're all buying growth stocks. I mean, AI is definitely helping juice and get everybody really motivated, but it's really just sucking in a lot of people who have FOMO. They don't want to miss out on the AI. They're chasing prices higher. But we're in this complacency stage, I think. And I mean, it doesn't matter which way the markets go in terms of trading or investing, because I follow the trends. I'm not trying to pick a top or anything. But overall, we need all these people to cover the shorts. As you mentioned earlier, when you look at the COT data, there's a huge amount of shorts covering right now in the equities markets. It's huge. And we need all those people who are short to get out to buy long. And the market doesn't make a big trend until it's going to inflict maximum pain. And right now, the maximum pain is getting the shorts out. They can't take it. We broke that high, volume's picking up. And once everybody is bullish or out of the market, then the market's probably going to turn down and start this huge decline and inflict maximum pain. Now that everybody's long the markets, it's going to drop. And so the mass psychology is constantly just chasing the fear of missing out. They got to get in, they chase it, and then it rolls over, and then they have fear and they panic out at the low. I mean, I've seen this cycle happen. I see it happen, all the time on an intraday chart. I've seen it happen bear market cycle after cycle over the past 25 years. It's the same thing all the time, but the majority of people don't fully grasp the market and the sentiment and how the emotional game is played with them. And the technicals clear a lot of that up, which is important, because then you're not running on emotions, you're running on proven. Is if the price trend is up, we're going to be long. If it's down, we're going down. If I think it's going to go down and it keeps going up for the next 2 or 3 years, well, that's fine, because our investment strategy is long right now. We're long equities with the indexes and the SP 500. So it doesn't matter if I'm right or wrong. We follow price. And that's the key that people need to understand. It's not about trying to guess what the news is and are we entering a recession? It's just follow the bloody price. And it doesn't matter what happens. Just manage those positions.
Could you say that the more momentum it builds, let's assume that the correction is inevitable. Can you say that the more momentum it builds, the more pain we'll see later on when it does collapse?
Yeah. So it depends how you look at momentum. So if price keeps ramping up and starting to go parabolic, like the Nasdaq and the SP 500, like they're running up the 5-day moving average. That to me is a very strong trend, and it's it can last a while, but if it goes too long, it starts to more or less start going straight up. And what goes straight up, I typically tell everybody, it's probably coming straight back down, at least for half of that rally. So it's usually a fairly short-lived move. So the more it goes up, the more danger it has of it coming down sharply. And we've got a lot of momentum. I think we're still going to see quite a bit more momentum over the next few weeks of people piling in and buying options and betting on the long side, thinking that this pullback might be a buying opportunity, and we might see another push higher still, which I would like to see. And if we see a lot more leverage plays, the put call ratio is a good way to gauge that. If we see a lot of the COT data, as you mentioned, if there's a lot less shorts, that's telling us that there's a lot of momentum to the upside. And eventually, I think the market will reverse and create a much bigger drop and collapse. But it might still, this trend might still last several more weeks. So I'm interesting. This is going to be a big week and see how it holds up, I think, going forward, because our short-term indicators are saying, hey, we're in for a little bit of a pullback, 3, 5, 7, 8% potentially. And then we need to see how it handles, what it does after that.
If you were to just look at how the market's behaved over the last 6 months, actually ever since the October lows of 2022, would you say, Chris, that anything has surprised you in the way that markets have moved? People have been talking about fundamentals with the economy and how things are starting to deteriorate. There's still growth, positive growth, but for example, the New York Fed has predicted that there's now a 70% chance, 71% chance of a recession. This is the highest probability they put out since 1982. This is higher than in 2008. And yet the markets continue to go up. Either they're ignoring these signs or the market's already pricing it in. Basically, my question is, Chris, why have markets continued rallying over the last 2023, and has this pattern surprised you at all?
It hasn't really surprised me. I figured we were going to go into some big sideways consolidation. The patterns that we're seeing right now are very similar on the indexes to what we saw in 2007, 2008, just before the big leg down. We saw almost the exact same type of price action in 2000, just before the big tech bubble. So this rally back up, from the October lows, I don't know how much the market has rallied. It's a pretty big, depending on the index,
Nasdaq's up about 26%. Yeah.
Right. So from those lows, it's a big rally, but I mean, we've seen these 25 to 60% rallies back before the market rolls over and dies. So in 2000, the Nasdaq rallied back something like 60%, or maybe it was 43 or 60%. It was huge, and then it rolled over and went down to fall 80% after that. In 2008, we saw this rally bounce. It was about 24, 25% as well. And then it hit this kind of threshold we're starting to reach now. It rolled over and we saw it crash. It went down 50 plus percent. So all this is in the norm. And I think, even though it's been a big rally and, you look at the NASDAQ, how much it's up this year, I think people get a little bit confused in terms of, actual performance of the markets. A good example of this is, let's just take a look at here's a chart here. So this thick blue line is called my CGS, my consistent growth strategy, where we're either in cash or we're holding assets going up in value. This thin blue line is the typical 60-40 buy and hold portfolio. I updated this just last week. And more or less, the portfolio is well below the highs that it made back in 2021. The NASDAQ is down huge compared to its highs back in 2021. So is the SP 500. And so, you look at the NASDAQ, I think the NASDAQ's up like 30 something percent. People are like, it's been a huge move this year. But the reality is the NASDAQ, if we go and take a look at it, is well below its highs. And you're still underwater. It's still down. When we take a look at it, it's down roughly, 10, 11%. So people are like, oh, there's this huge rally. I mean, we did catch this rally, which is why we're seeing our accounts push to all-time highs. But, just because we have this big rally this year doesn't mean we're in a bull market. The market is well below the highs, and it's all about trying to have this consistency where when the market pulls back, we're either, sitting in cash and we have the occasional little trade, but we want to keep pushing higher and higher. And that's the big difference between managing positions and buying and holding. People are like, well, this year the market's up huge. I'm like, no, it's up huge from where the market's closed the previous year, but you're still in a losing position. And if you just look at like, for example, somebody asked me, how much, what is your account up this year? And if I was to take a look at it, I'd be like, okay, well, year to date, as of last week, we're up a little bit more. We're only up 2.424%. And the guy's like, well, that's terrible. The NASDAQ's up like 30%. I'm like, okay, well, the NASDAQ is not hitting all-time highs. We're hitting all-time highs with our account. And that's because we don't ride things down. So I don't care. I mean, we caught a piece of this rally, but I don't care if we miss a 30% rally in the markets if our account keeps hitting all-time highs every few months. And so people get blinded by, well, how much did you make year to date compared to the SP 500? And just because we make less than it in terms of year to date, we're crushing the markets, hitting all-time highs with our accounts. So many people get caught up in just looking at a little window. How much did you make in this window between the SP 500? Where investing in trading in the stock market is not a short-term game. You can't just pick a window and say, okay, well, are you better or worse in this window? And if you're worse, I don't want anything to do with you. Investing in stock trading, I think a lot of people struggle with the reality that it's not there to make quick money. I mean, it's possible, but the reality is, over the long run, the stock market is a long-term game. You need to manage positions. It's all about having steady growth, consistent growth, and not going down. And believe it or not, the stock market's got huge potential or huge returns on average. If you actually compare it with the real estate market, they both on average long-term make about 8.5%. And, trading is a high risk, high emotional, you need to be very, very skilled to trade and invest. And so many people are like, well, I want to get into it. I'm like, well, I've been doing it for 25 years and I'm still learning every day. And, so many people think it's just like an easy thing to get into, but it's a real struggle. And unless you're going to dedicate the rest of your life to learning every day and every month and evolving, and there is no fixed set strategy. Things have to evolve with volatility and trends and market conditions. I wouldn't say get into the financial markets. You got to commit like it's a marriage for the rest of your life, and be in love with it, because it's an ever-changing beast. If you can't do that, you've got to follow obviously signals or someone who knows what they're doing, so that you don't take a beating when the markets go down. And but people want to be traders. I get it. It's fun to trade, but it is typically a losing battle, and it requires full dedication going forward.
Well, 50% of marriages end in divorce. So I don't know if that was a great example, but I get your point. I understand what you're saying, Chris. Certainly, people have commented on your cash position. You've talked to me several times about how you're holding cash. Let's talk about your philosophy with cash once more, Chris. Now, one of the criticisms I've seen is that investors may want you to be deployed, because let's say you've got cash and you're not using it. Well, you're missing out on the downside if you're not shorting, and you're missing out on the upside if you're not long. So how would you respond to that criticism?
Right. So if we're in like a topping phase, like we are at what I call a stage 3 topping phase, when the market is trending down, we don't try to profit from falling markets. Just because at any point it hasn't fully confirmed it's in a major decline. Yes, 2022 is a big decline, but we don't know that for sure until it's kind of happened. And when we get into a stage 4 decline where there is literally blood in the streets, companies are going bankrupt. I mean, it's the whole sentiment, everything shifts. When we get into a stage 4, we trade inverse ETFs and we profit from the collapsing price. But during a bull market and during a topping phase, we don't try to profit from falling prices. In a bull market phase, like a stage 2, pretty much every time you try and short, when a technical gives you a signal, you only have 2 or 3 days before it turns around and starts to rally again. And so you get into a trade and they pretty much always end up in a small losing trade. So it's not worth trying to squeeze something out of a bull market to the downside. And a topping phase, yeah, there's some good opportunity there. But you typically don't really know until it's almost like well underway, and it's still not a confirmation that you're going to consistently see it sell off. 2022, there were some beautiful big waves, massive sell-offs to the downside. I mean, you look at the charts of the NASDAQ and stuff, and I mean, these were huge, huge sell-offs. If I was to just pull the chart up, you can see how crystal clear they were. And we had these huge moves down. I wish we traded them, but the reality is we protected our money. We made some small trades to the upside because we're still technically in a topping phase. We're still in a consolidation or a rising trend. So we play very defensive, and so we don't take advantage of this downside. When the market eventually breaks down and starts at stage 4, every time we go from a green to a red bar, we'll be buying an inverse ETF, and we'll watch our accounts, rocket higher as the market collapses. But we're just not there yet. And this is another, I think, false belief that or misconception that people have. They think just because there's a big pullback, it should have been traded. You should have made money on it. Or if there's a big rally. But if you're managing positions, following trends, sometimes they just slip through the cracks. You can't catch every move. And hindsight's 2020. Looking back, I'm like, oh man, that would have been absolutely amazing to play those downside moves. We would have just been out of this world. But the reality is you can't catch every move. You have to have rules and protect your capital. You can't just be a cowboy and say, well, I'm going to go short because we got a sell signal here for, kind of any reason that, doesn't follow the technicals. You're now just becoming discretionary. You're trading off emotions. You're trying to make more money. And it's not the way that I do it. I want to protect my capital, and I just want to be in the markets when, everything's primed and ready, and confirming that there's a trend, and go from there.
So earlier today on Wednesday, Fed Chair Jerome Powell gave a testimony before the House Financial Services Committee, and he reiterated a lot of the things that he said at the last press conference about a week and a half ago. But he said that nearly all FOMC participants expect that it will be appropriate to raise interest rates somewhat further by the end of the year. When you hear a statement like that, Chris, does it change your trades at all?
No, not at all. I think interest rates are probably bearish on the equities markets. I mean, we start to get to 5%, 5.5%, 6%, return with no real risk. It starts to become a pretty good play for a lot of investors, right? It's a nice conservative way because we are in a very choppy market condition here. It's been like this for a while. So raising rates could be, a turning point in the markets later this summer.
But generally speaking, do Federal Reserve statements and announcements concern you as a trader?
No, not at all. I know it concerns most other people. We've got, subscribers. They're like, what are we going to do? We're in the trade. The Fed's coming out, and they all want to adjust the trades. We need to do this. We should get some of it out. I'm like, guys, you can't predict the news. The market typically, when it's in a trend, is going to continue. If the news goes against the trend, it's usually a short intraday blip, a one-day pop or drop. You don't know what's going on. So why would you adjust something when you don't even know if that adjustment's any good? So people want to do it to try to reduce risk. But I mean, the fact is, if you just follow the technicals, the news always has a way to seem to play out in most cases in our favor. So I don't take any of it into account. I don't adjust the trades. We just stay in what we're doing. We're not trading anything that's crazy high risk. I mean, we're trading the indexes. They're fairly conservative. They're not like a growth sector or stock that can drop 15 or 20% in a day. So.
Yeah, something I've noticed is that in the past, on occasion, when the Fed gives a statement where, let's say, the dot plots is more hawkish or more dovish than was initially expected, you see a big intraday move. Like actually, last time they had an FOMC meeting, there was a big intraday move. First, the stock markets were up, but then 2 p.m. hit. And then Powell started giving his press conference. It started sliding dramatically after people realized he was a little bit more hawkish than anticipated. But then, you saw it slide, and then you saw it bounce back up a couple of days later. It seems to be that a big intraday move usually is followed by a reversal. Have you noticed that?
For sure, yeah. Typically, whichever way the initial move is, off that news, it usually
Yeah.
rebounds the opposite direction by
Why?
the
Why
end of
is
the
that? Why does
day.
it? Why does that happen? Why doesn't that trend just continue?
Yeah, I think it's just a wave of people on the wrong side or betting against it, and then I don't know. I mean, it's an emotional move. All it is a whack of computers doing what they've been told by somebody, and it's a whole bunch of people chasing
But
the news, going, "Oh my
do you
God, I can't believe that just happened," or "I'm on the
do you
wrong
trade
side," or
that? Like you see a bounce below, let's say a Bollinger Band that you're not comfortable with, and then you trade the opposite side. Do you ever do that?
yeah, Bollinger Bands are a really handy little tool. They're good. I like to follow Bollinger Band. I actually teach how I trade and how I use the Bollinger Bands to identify buying opportunities. And same with my New York Stock Exchange buy and sell panic indicator. Those two together on like a 30-minute chart or a daily chart. I shared in my book Technical Trading Mastery, the one I just published last month. How I do those and the settings I use for it, because they're really powerful. They create these knee-jerk reactions, rebounds that you just mentioned, and it's great for short-term momentum traders who are intraday or 1 to 3 day buy and hold. There's some good opportunities in the markets.
So you mentioned that eventually we'll get a correction when this complacency phase is over. You referencing your phase chart. What is the inflection point we're looking for, or any sort of indicator for an inflection?
If we're taking a look at the SP 500, let me just pull the chart up and we'll just take a look at it together here. Uh, you're talking for the SP 500. So if we were to look
Yeah.
here, I'm going to go to the weekly chart. And, this market has the potential to maybe work its way back up to a double top. I've been talking about this with subscribers. We could see the Nasdaq squeak its way up into this topping area, maybe not to new highs, maybe just into kind of this body area. So if I was to just box that in, if obviously there's a lot of different things at play here. We're going to potentially push up into this resistance area. If it does do that, we're going to see, it could be a major double top. And when it comes down and eventually breaks down, it's going to get really ugly and catch most people off guard, because this is the phase here, right here, is where everybody piles in and they get on the wrong side. They all buy long. They're all thinking we've started a new bull market for the next 5 to 10 years again. I mean, they're in the wrong mindset, bunkered down, thinking happy thoughts. And this is where most people get sucked into things. In terms of a pivot point, if we zoom in on the NASDAQ here, this level right here that we pretty much just tagged a week ago, it pierced up and tagged it and is pulled back. This is a pretty significant level on the chart. So for the NASDAQ, that is roughly, $372 per share. If we zoom back, it's kind of through the noise of this kind of whole oscillation. And, that's going to be a pretty important part, that if we close above that, we could see more of a short squeeze coming up. For example, when we broke this one here, I mean, we saw the market just scream to the upside, right to the next resistance level. And that was a lot of shorts covering. So this will probably be the final straw. If it closes above here on a weekly basis, which is what this chart is, we could see one more squeeze of the shorts who are still holding, who are in like maximum pain. They see it blast through here and they're like, I can't take it anymore. This is brutal. I'm getting margin calls. So this 372 on the QQQ, if it breaks and holds above that, we could go into one of these 2 or 3 week screams to the upside, and everyone's going to feel like they're missing out. It's not only going to create the shorts to cover, but the general masses are going to be like telling their advisors, get me back into stocks, get me into growth stocks. I want to be part of this. And that's where the damage comes in. Everybody loads up, right? Buy high, sell low. That is the mentality of the investor. They're chasing the money, and chasing money is not how you earn it.
So you're saying that a revisit to its previous all-time high is actually a bearish signal? Because, if somebody says to you, Chris, I think that if it goes just above the previous all-time high, that means momentum is going to be assured. Would you agree or disagree with that?
There's no doubt the trend is up. The momentum is strong. But we'll be long the markets, and we are long the markets right now. But I will definitely be thinking, okay, this has the potential to be that major double top in the equities markets. and we'll keep our eyes peeled for to see how things start to
No,
break down
I'm just
after.
saying generally when you look at the charts, does a revisit to its previous high, is that usually an overbought signal or usually a signal for continued momentum to new highs?
Typically, if the market runs up here and hits that high, usually you're going to see a wave of sellers step in and quickly drive it down for a few bars. There's a lot of noise in this high. You look how many weeks are in here, and they're big ranges. It's a big down day, huge up or up week, big down week. There's a lot of volatility. So as soon as it pokes up into this range around the 380 mark, price is going to be all over. There's going to be big bouts where we see on the intraday chart huge waves of selling. Big funds will be unloading positions, investors will be unloading, and then the next day we could see a big bout of buyers piling in. It's going to be one of those, it's a churning spot where shares are churning from people who are bullish and bearish and just swapping hands. And then we need to figure out, is that pause and that sideways chop going to be a platform to launch and break out and go much higher? Or is it going to become a little topping phase and break down? I mean, it's all just predictions and ideas, right? The key here is if it's rallying up and keeps rallying up. I mean, we're in a bull market phase again. Technically, we're long with our long-term investment capital. We're long the equities, and you can't fight it. I do think we're in a topping phase, and this could be a major double top. I mean, if we look back at the NASDAQ and go, back over here, let's go back to the 2000 tech bubble. This is where we saw the NASDAQ, collapse 46% or so, and then it rallied up 52. Everybody was in this complacency phase. And then eventually it rolled over and it went into an 80% decline. And this similar type of thing happened over here. 2008, we saw NASDAQ didn't quite have the same moves, but it pulled back. It chopped around, was complacent, had that kind of consolidation, and then it went into that massive stage 4 decline. And the SP 500 did the same thing. And when we look at it where we are today, if I fast forward it, we're in this phase where it is moving up. We've had this initial move down in the NASDAQ. We're down 37%. It's now rallied up. It's roughly 46, just like it was in the tech bubble. I mean, it was huge percentage swings. And then eventually it just runs out of steam and we have a financial reset. And I mean, there's a lot of different people there's a million reasons for the markets to correct and sell off. And, it's been juiced for years. There's a lot of potential downside. So it'll be interesting to see if that unfolds. And my analysis points to it. But again, I don't really care which way it goes so much because we're going to be able to take advantage of both ways. And so my point is, I'm not trying to predict and tell people what it's doing. I'm saying this is what you need to be aware of because there could put in a double top. And if it starts to roll over, you better not be holding on to that falling knife or that waterfall sell-off because things could get really, really ugly going forward. And knowing that allows you to at least put some fail safes into place. And if the market falls 15% from where it is, maybe you want to move to cash and wait until there's a new clean bull market to get involved or take advantage of the downside. Something to limit your risk from losing, 30, 40, 50% of your capital. It's the last thing anybody wants is to see 20, 30 years of your life savings just evaporate over one stupid decision of just to buy and hold something and be like, oh, it'll be okay later, right? The NASDAQ took 16 years to recover after this. SP 500 took 12 years, after the tech bubble. And then it took, 7 years or so to recover after the 08. That's a long time to be down huge money. It's hard on relationships. It's hard on everything, lifestyle downgrades, you name it. So it's just not worth it.
I'll just end on this note. And, I've been seeing comments on my channel from people watching about how a lot of people are predicting either a crash or I actually have an even number of bears and bulls. It's just that the bulls have a different group of critics. But yeah. For the bears out there, they one of the common criticisms I've already addressed with you, which is that you're sitting on the sideline, you're not making the gains. Actually, there's a psychological thing to this. Psychologists have analyzed that it actually hurts more to miss out on certain things than it does to actually lose on something tangible. So in other words, if I lose an X amount of money, yeah, that sucks. It hurts. Obviously, if I lose my life savings, that's terrible. But if I just lose a small amount of money, let's say I lose $10,000 or whatever, that's terrible. But if I don't make $10,000, I psychologically feel worse than if I just lose a $10,000, because I'm thinking, oh, I can just make that back. But then I'm thinking, if I miss out on the gains of $10,000, I'm never making that back, in the sense that it's gone. That opportunity disappeared.
Yeah.
So it's a psychological thing.
I've talked about it. I've wrote about it with subscribers and stuff. It is. And I mentioned that once. I'm like, it's more, people are more worried about missing out. And if they see a big rally without them, it cuts twice as deep. And I mean, so many people wrote back to like, oh my gosh, that's exactly how I feel. And that's where people's weakness is, the emotion. It's tough. Missing out on moves. The FOMO is so powerful unless you can literally step back and be like, okay, I don't need to catch every move. I don't mind sitting in cash when things aren't safe, and there's going to be big whipsaws, but the market is always moving. Every day, every week, there's new opportunity. So who cares if you miss a rally for a week or two or three or whatever? There's always going to be more. The markets are constantly moving. So it's about protecting your capital first. And then when there's a clean setup, you jump on and you catch that move. And that's the key. But people think and they want to catch every move, but that's usually what gets you into trouble. And then you're always in a trade, and trades aren't always good. So it's a tough battle.
And we have to know you're not always fully in cash, and you're not always fully invested either. You kind of, switch depending on what's going on in the market. So what would make you pivot, in the sense that what would make you go all in either direction?
So we need a bunch of technicals to break down. Like right now, we just hit 15% target on our last portion of our QQQ trade. So half of our portfolio goes into the QQQ, the other half goes into the SPY. They're both different indexes. They move differently. As we can see, NASDAQ's up huge. SP 500 is trailing, but not up as much. So we would need technicals to break down, meaning we need to see different assets doing different things, outperforming the equities markets. We're going to need to see momentum shift. We're going to need to see cycles turn down. So there's a lot of different things that come into play. And I wouldn't say we're getting closer to a potential top here, which is what I've been talking about with subscribers. Sentiment is definitely showing, okay, everybody's chasing prices. They're covering their shorts. Cycle-wise, we're not quite there yet. We still could be a week or two away, but we could be getting close to an actual sell signal and moving out of all the positions. And that's because sentiment and cycles in price are all telling us that, hey, now is a time to close out the trade, wait for the market to regroup. When it has a clear uptrend, we'll get back in. If it resets and goes down deeper, we just have to wait it out in cash and know that instead of losing money, we're just sitting there fat, dumb, and happy collecting interest in our account. And people should be happy with that. Although people want to make money in every move, but it doesn't really work that way in reality.
So you're a trader, but you also write newsletters regularly. Where can people follow your work? And I think you have a new book out. Tell us where we can find your writings.
Sure. Yeah. So I've got my, if you go to my website, thetechnicaltraders.com, if you join my free newsletter there, you can scroll to the bottom, you can get the infographic that shows the market stages, the market emotions. And we didn't go down to the third one, but it shows the cycle of what assets perform best throughout these cycles. And of course, we had crude oil leader in 2022. Precious metals were the leader earlier this year. Those are the last two sectors that usually do very well just before the stock market struggles and tops out. So that is a big red flag. So if you want to get on that free newsletter, you can go there and do that. My book, it's called Asset Revesting. So it's more or less giving power back to the investor, the individual, to not just hold on to assets like stocks and bonds, but to actually focus on holding only assets that are going up and sitting in cash comfortably and safely when the market's not safe. So you can go to Amazon and get that, or you can go to my website. There's a menu there called books. You can go and click on there. And then, of course, if you want to talk to myself or the team here, you can give us a shout on our website. And I can talk to you. And if you go to our blog, we got lots of videos, and David and I have done lots of good videos. They're all listed on there, and articles talking about your personality type. The reality is 81% of personality types do not cater to financial success when it comes to trading. This is a report I put out. It's pretty interesting.
Well, that's grim. Thanks for that. That's why I'm not a trader. I tried it.
Yeah. If you don't know your strengths and your weaknesses, like most people are emotional, to get caught up in the news and emotions. And that's most personality types, are touchy-feely, emotional style. There's nothing wrong with them. But you need to understand that if you are one of those personality types, you need rules and systems or something to follow that can trump your emotions. And it's super important, or else you're just constantly just a typical investor and trader chasing the money and never really growing your account by leaps and bounds every year. Just, you're not hitting those all-time highs that we all want to hit. Emotional traders struggle huge, and it always holds them back.
You know what I'm gonna do next time we speak, Chris? I'm gonna pull up a bunch of ChatGPT generated answers on how to trade, and I'd like you to evaluate how a robot thinks. I think that'll be fun.
Sounds good.
Take the emotion out, Chris. Let's see how a bot does.
Yeah.
All right. Thanks for your time, and we'll put the links down to your work below, so check out Chris's work. Thank you again. Thanks for coming on the show today, Chris.
Thanks for having me. Take care, guys.
Yeah, take care, and thanks for watching. Don't forget to subscribe.